Hey everyone, what's going on? Welcome to Finance Flicks Hub, the place where we cut through the noise and invest with clarity. Today, we're diving into 4 stocks I'm buying right now, real positions, real reasons. But before we jump in, stick with me. I am also breaking down the broader market backdrop and why the next few months could be full of opportunity or volatility. Let's get started. Market context. What's happening now? The buzz across Wall Street. Markets are rallying on renewed hopes that the Federal Reserve, the Fed, will cut interest rates soon. Most analysts now expect a quarter-point cut, possibly coming December 2025. That expectation has lifted investor sentiment and helped push stocks higher across sectors, especially financials, tech, and growth plays. At the same time, we're seeing relatively solid corporate earnings overall. Many large companies beat expectations in Q3, which helps support valuations, even if economic growth remains fragile. That means now can be a sweet spot for investors. Lower interest rates tend to boost discount rate calculations, making future cash flows more valuable. And stable earnings give a cushion, a favorable setup for both growth and value-oriented stocks. With that macro environment in mind, here are the 4 stocks I'm holding and why I think they have real potential. Stock number 1. SoFi, why I'm buying it. SoFi has recently surged, and I like that this rally is backed by both technical strength and real business fundamentals. Stocks had a major move over the past week. That SA classic by the dip scenario, high-quality companies that get discounted down T stay down forever. Historical resistance around $32. If we push past that in the next 30 to 60 days, a move up toward $35 seems very realistic given momentum. Business strength SoFi isn't just a fintech hype. They're building a full-service ecosystem: banking, loans, credit products, investing. Their model hinges on high customer lifetime value (LTV) with multiple customer touch. As they cross more revenue and scale, the upside becomes very interesting. Why it fits today's market, with interest rate cuts likely and financials benefiting from better macro conditions. A company like SoFi, combining fintech growth plus financial services fundamentals, could perform especially well. Stock number 2, NVTS Navitas. What they do and why I'm interested. Navitas makes cutting-edge gallium nitride GaN power chips, replacing older silicon chips with something faster, cooler, more efficient. Their products have potential use cases across fast chargers, electronics, EVs, data centers, basically sectors that just keep growing. Risks and position sizing. This is a small cap, higher risk, higher reward play. I'm keeping the position small, especially in a potentially volatile macro environment. Why now could be good as tech and infrastructure spending grows, especially with AI, EVs, renewables, battery tech. Companies like Navitas may benefit disproportionately. If markets rally and risk appetite returns, small high-growth tech plays could see strong rebounds. Stock number 3, IREN Energy. Company shift. And what they offer, Iris Energy, started as a crypto mining operation, but is transitioning into AI and data center infrastructure, offering renewable-powered GPU and compute services to AI cloud players. Competitive advantage: their data centers run on cheap hydroelectric power, a big edge in energy-heavy GPU data center environments. They're scaling quickly, adding large GPU capacity, positioning themselves among major data center AI infra providers. Macro alignment: with AI demand surging, cloud compute needs rising, and energy costs squeezing many. A clean energy data center operator like Iris may benefit. Combined with a potentially easier rate environment, this could be fertile ground for long-term gains. Stock number 4, Chipotle CMGY. I still believe in it, despite recent pullbacks and macro headwinds. Cost. Consumer caution: Chipotle remains a strong long-term value play. Expansion plans remain aggressive. Their digital business and pickup lane Chipotlane adoption continues. More digital orders equals higher margins. Their brand and menu flexibility give them resilience in an uncertain economic climate. Valuation plus timing at around $32, $33 per share. The stock is discounted compared to its long-term growth potential. If rates drop and consumer sentiment improves, this could be a solid rebound candidate, possibly toward $37, $40. Final thoughts: why this mix works now. With interest rates likely to fall soon, earnings still holding up, and tech plus financials showing strength, we have a macro environment that supports both growth and value plays. By building a diversified portfolio, including a fintech growth play, SoFi, a high-potential small-cap tech Navitas, an AI infra data center operator Iris, and a resilient consumer business Chipotle, I'm positioning to capture upside across multiple economic scenarios. If you're investing now, it's not just about picking winners. It's about balance, timing, and macro awareness. Outro plus CTA. Thanks for tuning in, and thanks for watching Finance Flicks Hub. If you enjoyed this breakdown and want more market-aware investing content, make sure to like, comment, and subscribe. I drop videos like this regularly. Catch you in the next one. Until then, stay sharp, stay patient, and invest smart.